What up, world? Yeah. All right. So, y'all see the headline. It says the three most undervalued stocks to buy in April of 2024. But I just wanted to, I actually wanted to zero in on just one of them. I want to zero in on Decker's Outdoor. This one, I mean, all weekend long, I just been seeing people walking around in Hoka shoes out here in California. There's a lot of people wearing them Hokas to walk around. So Decker's Outdoor, the ticker symbol on the NYSC, if you want to go and check it out, is DECK. And yeah, so they continue to deliver impressive financials. So Decker's Outdoor is a holding company that owns Hoka running shoes, and they own Uggs. They also own Teva sandals, and they own another pair of shoes. I think it's Sanooks. So they got a few good shoes all shoes that I've heard of. When I used to sell shoes when I was in college, we sold. People loved their Teva sandals. They didn't have Hokas back then. That was like 2011, 2012. And but they had Sanooks and they had Uggs, and Uggs. We sold out of Uggs every Christmas, like you know what I'm saying? It was like clockwork. Like you already knew they was getting sold out right away. So revenue increased by 16% year over year to record a $1.56 billion in the third quarter of fiscal year 2024. Profit margins expanded to 25% thanks to the company's 40% year over year net income growth. So the amount of money that reached the bottom line after they pay for everything, 40% of it, 40% of every dollar, which is crazy. So the corporation is putting some of its capital into stock buybacks. It's important. So revenue increasing 16%. Let's get into that. Like 15% and above for revenue year over year increasing is respectable, and it's like good. Like you're like a B student if you doing 15%, right? So you're not middle of the pack, and you're not up in the nosebleeds. You're not dead last either, right? 20% or more revenue increase year over year is like that's A student level. Just so for all the beginners out there, so you could like really comprehend the numbers and why this is such a good company and it's undervalued. So the corporation is putting some of its capital into stock buybacks. That's important. They repurchased $99 million of its shares in the third fiscal quarter. Decker's Outdoor still has $1.046 billion authorized for stock buybacks. So the board authorizes, the board of governors, or the board of directors, for public companies, they vote on whether or not to buy back shares of their own company and how much money they'll set aside for buying back shares, and then when to buy them back also. So they set aside over $1 billion to buy back shares of the stock. So just like any other commodity or any other product in the market, let's go with Supreme Clothing. Everything is a one of one. So if there's 50,000 people who want a Supreme collab with Lululemon, or a Jordan collab with Travis Scott, if there's 50,000 people who want the item, right, but there's only 5 units of that item, the fact that there's not enough for everyone to get one will make the price go up, because demand is outweighing the supply, right? So this company is gonna buy up more of their shares that are out there floating around. So therefore, there will be less shares out there floating around. I think right now there's already only like 25 million shares, which is nothing, because if you think of like Apple or even Microsoft, Apple has like 2 billion, 3 billion shares out there. Microsoft has like 7 billion or something like that. So think of this company that has 25 million. That's nothing. So a lot of companies have 100, over 100 million shares out there outstanding. So there's like plenty to go around for everybody. So there's no reason for there to be a bidding war for the price to jump, because there's enough for everyone to go around. But this company is taking shares off of the market, taking them out of the public. So in other words, if you want them, you're going to have to pay more because there's less to go around. So stock buybacks, if you own the stock, you love it. And I'm going to buy it in this stock. So just disclaimer, whatever, just for transparency, yes, I will be investing in this company next week. Okay, so Deckers Outdoor is swimming in cash, and it grew its cash position from $1.058 billion to $1.6 billion year over year. So $600 million they increased their cash in 1 year. Just cash sitting in the bank ready to go do something with. So they could use that money to buy up other companies. They could use that money to build stores overseas. They could use that money to start paying dividends to the shareholders, whatever they want to do, right? It gives them flexibility to grow and to, do better. So the stock has comfortably outperformed the stock market as a whole and is up 515% over the past 5 years. 550. So that means every year, basically, it averaged 100% growth for 5 years, basically. That's crazy. Shares are also up by 34% year to date. So we're in the first week of April, and it's already up 34% this year in 3 months. Okay, it's crazy. More investors are realizing the company's value proposition. Despite its recent addition to the S&P 500, the stock trades at a reasonable 32 price to earnings ratio, given its financial growth rate. So it just got added to the S&P 500, which means institutions have to buy it, banks have to buy it, stuff like that. Wealth management funds have to buy it so they can keep up with the S&P 500, which is the benchmark that they judge themselves on. So they're judged every year by, okay, the S&P 500 grew 8% this year. If I grew 7, if they grew 7, then that means they underperformed and they did not basically pass the test. So in order to make sure that they don't underperform, the minimum they'll do is buy all the shares that are in the S&P 500. And then they'll make a few adjustments here and there and buy some other stuff that they see. If they think they notice something that no one else does, maybe some arbitrage, maybe if they find alpha, then we're all seeking alpha, but I digress. So yeah, in a 32 PE ratio. Okay, so I think Apple is like at 33 or 36, something like that. So basically, and Apple is known for being undervalued, or has been known for being undervalued for the past like 15, 20 years. Like this whole run that they've been on since I think the iPod came out. So that's why I compared it to Apple's PE ratio. So their price is about 32 times the earnings per share. So, and when you look at a lot of the companies out there, once you hit 30 PE, you're getting into like impressive territory as far as like what people are willing to pay for your stock. So people are willing to pay 32 times the earnings per share, and 30 is kind of like it's like what I'm trying to say is like it's like that's the line that's drawn for like everything under 30. Basically, people are not as impressed with your company, so they're not willing to overpay. Once you hit 30 and up, people are basically saying, okay, I'm willing to pay a little extra for your stock over what I would pay for another stock. So I try to compare it to like designer clothes. Like if the PE ratio was like 40, 50, 60, 70, 80, 90, 100, now we're like going into like fancy luxury items like Lululemon, Louis Vuitton shoes, Louis Vuitton purses. Like that's like a company that has 86, 110 PE ratio. Basically, investors are saying, I'm willing to pay a premium. I'm willing to overpay for your stock because I see your stock as being more valuable and being like luxury. So I'll pay whatever, like people will pay extra money for a BMW, for a Mercedes Benz. It's the same with these stocks. So I'd say the 34 PE ratio is like paying for either Lululemon or what other things are out there, like buying maybe a Ted Baker outfit, or buying a pair of Ray-Ban shades. Like they're not the most expensive. There's Ray-Bans don't cost as much as Tom Ford shades, but Ray-Bans, they cost more than most shades out there that you'll see on a cart in the middle of the mall that are like $20, right? Ray-Bans is people will pay extra for them. So look at it that way. Like once anything 30 and up, is like people are saying your product is considered quality to us. Okay, so let me see what we're gonna do. Let's look at the possible investment results. Okay, so for this, let's say you put. That's why it was negative already. Huh? Let's say you put $1,000 in. So this is a financial calculator. This will kind of tell you how much money your investment would turn into in a certain period of time. So let's say you put $1,000 into payment. Oh yeah, that's zero. Okay, I was wondering. I was like, what is this? Let's say you put $1,000 into a savings account. At a retail bank, Bank of America, Wells Fargo, JP Morgan, any of them. And then they're paying you how much interest? 0.25. So like not even a half of 1% interest. And then you do that for 5 years. How much money is your $1,000 going to turn into? Okay, that $1,000 in 5 years will turn into $1,012.56. Okay, so that's how much you'll get. So your $1,000 will net you $12.56 if you put it in the savings account. Now, on the other hand, it says the stock has comfortably outperformed the stock market and is up 515% over the past 5 years. So let's say you put that $1,000, You bought $1,000 worth of Deckers Outdoor 5 years ago. So the year before COVID hit, right? That's not that long ago. That's not that long of a wait. And let's say you're doing, okay, 515. That's crazy, man. That's a crazy number. 515% interest, which is per year. Okay, so it's not going to be 550%. All right, so what is, let me do it on my phone. All right, so 515% divided by 12. Oops. 515% divided by 5 years is 103% each year. So 1.03% each year on $1,000 investment. So I'm gonna put negative 1,000, right? Because you're losing $1,000 or you're giving $1,000 away to this company, to Deckers. You're saying, here's my $1,000. I'll be back for it in 5 years and see how well you do. And they're like, okay, boom. It's 5 years later. Here you go, Kezi. And you're like, oh, snap. Wait, is that? Yeah, I think that's correct. Okay. No, this isn't correct. Let me think. Interest 1%. Oh, did I put? Wait. I don't think I'm supposed to put that. Yeah, I was like, dude, that is not correct. Yeah, pretend y'all didn't see that. I put 1.03%. I forgot it's already in percent. I was putting it in the decimal form, but I forgot. But this wants the percentage form. It doesn't want the decimal form. All right. So now I'm gonna give Deckers, that sells Hoka shoes and sells Teva sandals and sells Uggs, I'm gonna give them $1,000 of my money, and then that's in 2019, and then 5 years later, I'm gonna come back and I'm gonna check on them to see what they did with my money and how much they helped it grow, if it grew at all. And they gonna say do calculations, do all these machine work. Oh shit! Wait, okay, wait a minute. This can't be correct. This can't be correct, man. What are we doing here? No, but I mean, hey, $500. I mean, 500% number of periods. 5 periods. So yeah, 100% each year. There's no way. $33,000. Bruh. What are we, bruh? 515. Yeah. Divided by 5 periods. $103%. That's crazy. Off $1,000? Dude. That's nuts. Interest per year. Dude. Number of periods, number of years, yeah. Damn. I don't know. Sorry, I'm like in awe. Dude, that's crazy. Yeah. This is okay. I'm glad I looked at this because now it makes sense now that I see the schedule. The first year, the first year, that $1,000, damn. First year, the $1,000 gained. Oh yeah, because of the 3. I was like, where's the 30 coming from though? Okay. Okay. Yeah, I get it now. I think. Okay, so the first year, the $1,000 that you gave Deckers at 103% growth that year, you get back an extra an extra $1,030 on top of the original 1,000, which creates a future value of $2,030. Okay, that's after 1 year. Then you leave you leave that $2,030 in there, right? The original 1,000 plus the 1,030 that grew, that was added from the growth, from the interest. That $2,030 stays with Deckers for another year. Okay, and that earns 100%, 103%, which adds $2,090 to the already $2,030. So when you add them together, after year 2, you end up with $4,120.90. Then you add another. That money stays in there. That $4,120 stays with Deckers for a third year, and it goes up by 130%, 103%, adding another $4,244.53 to the already $4,120.90. Oh my God, this is crazy. This is how interest works. Compounding interest works. It's amazing. And that leaves you with $8,365.43 after the third year. Then you keep it in there, and then that $8,365 grows another 100%, which means you add on 103%, which means you add on $8,616.39 to the already $8,365.43, which gives you $16,981.82 after year 4. And then you keep that $16,981.82 in the Deckers organization, and it adds another 100% in the 5th year, which would be this year, or this, up until now, right? This is the last 365 days leading up until today, and that adds $17,491.21 to the already $16,981. Giving you 34,000. That's why I thought it was a typo, because I couldn't believe it. I was like, no, I'm doing the math wrong. I have to be. No, this is correct. 34,000. So in 5 years, $1,000 turned into $34,473. That's crazy. And that's the power of compounding interest. That's the power of investing in the stock market. Like, it starts off slow, but if you just wait, and I'm talking to myself right now, because I've made so many blunders where I was just impatient, and I knew a stock was going to go up, but it was taking too long, and I sold it right before it ballooned. I've done that 50 times already. I should be a millionaire, like, easily, because of the stocks I invested in over the last 12 years. But each time I was either too scary to put in a big chunk of money, or I was too impatient to leave it in there and let it grow over time, or also too scary because the stock market would go down. But then it's like, come on, like I went to school for investment finance, so I know the stock market is going to come back up after it goes down. But that goes to show you this game is really an emotional and a psychological game. It's not just about knowing the ABCs or knowing the fundamentals or knowing what the knowing the jargon or knowing the vocabulary, what it means or stuff like that, knowing the definitions. Like, it's really psychological. Mental discipline. Let's go. All right, so let's look at this. Let's look at the deck. Let's look at the margins, the returns, and the market cap. So the margins, and then I want to compare the margins too, right? So gross margins are 54%. So that's how much money is left over after the cost of the goods, the cost that go into the shoes, right? The basic cost though, like the materials, and then like maybe distribution, shipping it, whatever, manufacturing. So $54 out of every $100, right? So out of every $100 they make on their shoes, on their products, whatever, they get to keep 54% of it. So out of every $100 they get to keep $54, and then after that they start, they still have to pay interest, taxes, stuff like that, equipment, whatever, general administrative duties, sales, costs, stuff like that. But profit margins, so after they pay off all the operating costs and stuff like that, then and paying the employees and stuff like that, like they actually have 21% of it. No, 17%. So operating margins are 21% and profit margins are 17%. Sorry, it's late as hell and it just kicked in. And then let's see, return on capital is 29%. Now let's compare that to let's see. Okay, so let's compare that to Nike. All right, so Nike is the big 800-pound gorilla in the shoe market game, right? In the shoe and apparel game. So Nike, their gross margins are 44%, so it's 10% less. Their operating and profit margins are 11% and 10%, right? Instead of 21% like Deckers and 17% like Deckers. So in other words, it looks like right now Deckers is running a more efficient operation, right? Now, let's look at return on capital, 29% for Deckers. Return on capital, 19%, so 10% less for Nike. Revenue per employee. See, I like this stat. Revenue per employee for Deckers, $980,000. Come on, man. We're talking about almost $1 million per employee that they gross, that they bring in revenue in sales before taking out any costs or any interest paid or any taxes or anything like that. And then Nike, revenue per employee, $616,000. So we're talking about like $300,000 less. $300,000 less in sales per employee. And look at Nike's profit per employee. $62,000 in profit per employee. Deckers, $172,000 profit per employee. So Deckers is just running a more efficient operation, right? The moves that they're making are paying. They are paying more dividends. It's like a more sharply run company. Return on capital invested. So when you give them capital to invest, or when they invest the money that they get from sales, that they get from customers and investors, if investors give them $100, they're turning that $100 into, or they're getting $29 back in sales. If Nike gets $100 from investors, they're turning that into $19 in sales. You know what I'm saying? So whatever Decker's doing, it's like they're getting more bang for their buck. They're getting more. Everything that they do is having a better and a bigger impact on the company's success than what Nike's doing. I know, and it's not totally fair or apples to apples, because Nike is already a mature company, whereas Deckers is still in the growing phase. So they got a lot of more room to grow than Nike. But the point is, look how they compare to the giant in the game, you know? And then let's look at market cap. Decker's market cap is $22 billion. Nike's market cap is at $134 billion, which means look how much room Decker's could possibly grow. If Nike could get to 134 billion, I'm pretty sure Deckers could get to 50 billion even, right? And that would double that's more than double where they're at right now. So if you buy a share at $879.89 today, then like there's plenty of it's a feasible possibility that that $879 will grow or will double over the next few years. And if you put that money in the bank, I don't know. If you put that money in a regular savings account, it ain't gonna grow. It ain't gonna double in a few years. It's gonna take 75 years to double, possibly, right? So what is this? You give the bank $1,000 at 0.25 interest rates. Percentage. Oh yeah. So I forgot what the number was. I think it was $12, right? Oh yeah, 0.25%, $1,000 over 5 years. Yeah, $12.56 is what you're getting back, as opposed to $33,473. I mean, come on, it's a no-brainer, man. This is crazy, man. This is crazy. So, I'm definitely investing in Deckers. And hopefully I have the patience to hold it for 5 years and let that compound interest grow. That $1,000 turned into 34,000. I still can't. I can't forget that. I'm gonna be dreaming about that tonight. All right, so that's it. But stay tuned for the next for my next clip. Stay tuned for my next clip. You know, if you like this and you got any value out of this, please like, subscribe to the channel, like the clip, leave a comment. What do you think about this company, about Deckers Outdoor? Do you know anybody? Do you see the growth of Hoka shoes, those running shoes everywhere like I do? Do you believe in what they're doing with Hoka, Uggs, Teva, Sanooks, all that? Like, do you think this company can double their market cap from 22 billion to 44 billion like I do? Because I mean, right now Lululemon is at 44 billion. So I feel like Deckers could get to 44 billion. And if that happens, that means they're going to double my money when I invest in them. This is not investment advice. This is just me sharing my journey on what I'm doing to grow my wealth. All right. If you want more if you want more content from me and this channel, make sure you subscribe and hit that bell for notifications. All right. It's your boy Kezi. I'm out.